Welcome to Newsbeacon, your trusted source for breaking headlines, global insights, and sharp analysis from around the world. If you're new here, don't forget to hit that subscribe button and turn on notifications so you never miss an update. This year, the global auto industry was shaken to its core as German giants like Volkswagen announced a dramatic retreat from the US market, sending shockwaves through both continents. The decision marks a turning point for an industry that has long relied on open borders and international cooperation to thrive. The move, triggered by President Trump's new 25% tariff on auto imports, marks a fundamental break in decades of transatlantic trade. For years, German automakers have been a fixture in American driveways, and their presence has fueled jobs and innovation on both sides of the Atlantic. Now, Volkswagen and others are halting exports of key models, severing a commercial artery that's pumped billions between Germany and America. The sudden stop is more than a business decision. It's a rupture in a relationship built over generations. The fallout is immediate. Factory workers in Europe face layoffs, and entire communities that depend on auto manufacturing are bracing for economic pain. Meanwhile, American buyers see fewer choices on dealership lots, with some popular models suddenly unavailable or delayed for months. And prices are set to rise, putting new cars out of reach for many families and squeezing household budgets even further. Instead of boosting US manufacturing, the tariffs have unleashed chaos, disrupting supply chains, stalling production, and destabilizing both economies. Suppliers and small businesses are caught in the crossfire, unsure of what the future holds. German automakers, once symbols of precision and quality, are now caught in a trade war crossfire, their reputations and profits at risk. Their global strategies and investments are in disarray, forcing a painful retreat from a suddenly hostile market and leaving long-term plans in limbo. The result? A deeply integrated industrial partnership is unraveling, with no clear winners, only uncertainty for workers, companies, and consumers on both sides of the Atlantic. The vision of a resurgent American auto sector is colliding with the harsh reality of a fractured global economy, leaving the future of the industry more uncertain than ever before. The turmoil began in April 2025, when a bold and controversial move sent shockwaves through the global auto industry. President Trump imposed a sweeping 25% tariff on all imported cars and parts, a decision that instantly redrew the landscape for automakers worldwide. The administration's stated goal was clear: force foreign automakers to build in the US, revive American jobs, and restore the country's manufacturing might. Officials argued that decades of lopsided trade deals had hollowed out US manufacturing, leaving communities struggling and factories shuttered. Tariffs, they claimed, would finally level the playing field and bring prosperity back home. A minor concession allowed a small exemption for steel and aluminum, but for most automakers the new reality was unavoidable. Practically overnight, importing a car became 25% more expensive, sending shockwaves through dealerships and showrooms across the country. Automakers who plan years ahead and rely on stable supply chains were blindsided by the sudden change. One CEO called the move poison for long-term investment, warning that uncertainty would chill innovation and expansion. The policy was a wrecking ball, not just a tax, upending the global auto industry's carefully built supply chains and threatening to unravel decades of international cooperation. Foreign brands faced a stark choice: absorb huge losses, rethink their US strategies, or risk being priced out of the market entirely. Many passed costs to consumers, leading to sticker shock and a sharp drop in sales as buyers hesitated or walked away. The result: radical uncertainty, frozen investments, and a market where the rules could change overnight, leaving both workers and investors on edge. The full impact of this protectionist gamble is only beginning to emerge as the world watches to see if the gamble will pay off or backfire. Volkswagen's response was swift and dramatic. Almost overnight, it pulled several of its most iconic models, like the Golf R and Passat, out of the US market. These cars, once staples of American roads and beloved by enthusiasts, suddenly vanished from showrooms, leaving both dealers and loyal customers stunned. The 25% tariff made selling these imported vehicles unprofitable, and passing those extra costs on to buyers would have killed sales entirely. For many, the price jump was simply too much to justify, especially with so many alternatives available. This retreat only accelerates a trend that was already underway, as Americans continue to shift their preferences from sedans and hatchbacks to larger SUVs and pickup trucks. The market for traditional European cars was shrinking even before the tariffs hit. But Volkswagen isn't leaving the US entirely. Its Chattanooga, Tennessee plant will keep building SUVs and electric vehicles specifically for American buyers, allowing the company to bypass tariffs and remain competitive in a changing market. This new strategy, build where you sell, insulates Volkswagen against trade volatility and political uncertainty. It's a pragmatic move, but one that comes with trade-offs for both the company and consumers. Chattanooga, once a symbol of global partnership and international cooperation, is now being transformed into a fortress of production in an era of rising economic nationalism and protectionist policies. The loss of European sedans and hatchbacks shrinks consumer choice and weakens historic industrial ties between the US and Europe. For car lovers, it's the end of an era. Domestic and other foreign automakers may struggle to fill the void left by Volkswagen's exit, especially for those seeking something different from the mainstream. The move is a stark reminder of how quickly political decisions and trade disputes can reshape entire industries, leaving workers, consumers, and communities scrambling to adapt. A brand once synonymous with accessible European engineering is now forced to shrink its American presence, marking a profound shift in the automotive landscape. The tariff shock hit all German automakers, not just Volkswagen. Mercedes-Benz scrapped its 2025 earnings guidance, warning that US trade policy could devastate profits and cash flow. Porsche slashed its revenue forecast, citing the tariffs as the main culprit. The 25% tax is a direct assault on luxury brands' business models, forcing them to choose between massive price hikes or shrinking margins. Volvo, owned by China's Geely, also abandoned its financial guidance and announced major global cost cuts, including layoffs. Stellantis, with both American and European brands, withdrew its outlook after a sharp revenue drop. The industry's collective response: suspend forecasts, freeze investments, and brace for chaos. The tariffs have created a fog of uncertainty, choking off growth and forcing desperate cost-cutting across the sector. For American car buyers, the impact is immediate: fewer choices and higher prices at the dealership. The disappearance of models like the Passat and Golf R shrinks entire market segments, especially affordable European sedans and hot hatches. With less competition, prices rise, not just for imports but for domestic cars too, as automakers face less pressure to discount. The Inflation Reduction Act already favored US-made EVs. Now, European and Asian brands face a double penalty: no tax credits and a 25% tariff. For many, European EVs are now simply unaffordable. The American consumer is squeezed by shrinking options and rising costs. The promise of America First is translating into America Pays More. The vibrant, diverse auto market Americans once enjoyed is being dismantled. Less variety, less innovation, and higher prices are the new normal. Every trip to the dealership is a reminder of the true cost of protectionism. The tariffs, meant to protect US industry, are hurting American automakers and workers. Even cars built in the US rely on imported parts now taxed at 25%, driving up costs and squeezing profits. Ford's CEO warned the tariffs would slash earnings by $1.50 billion, money lost for innovation, factory upgrades, and wages. Ford and others have suspended financial guidance, highlighting the uncertainty. US plants of foreign automakers like VW in Tennessee face risks too. If parts get too expensive, jobs and investments are at stake. Thousands of American manufacturing jobs now hang in the balance. As costs rise, it's harder for US brands to export, threatening their global competitiveness. The vision of a protected, prosperous US auto sector is giving way to rising costs, falling profits, and deep uncertainty. Automakers are rethinking global strategy. Build where you sell is the new mantra. Audi and Porsche are exploring a joint US plant, a multi-billion-dollar bet to stay competitive. But even US factories can't escape tariffs on imported parts, keeping costs high. Some experts now advise shifting focus away from the volatile US market to more stable regions like Asia. In the short term, German brands rushed to stockpile cars in the US before tariffs hit, but that's only a temporary fix. Once inventories run out, prices will spike and choices will shrink further. The UK secured a special deal, but most countries face a patchwork of tariffs and uncertainty. The global auto industry is being reshaped by political maneuvering, not market forces. Fragmented bilateral deals are replacing broad, multilateral trade agreements. The auto trade war is fracturing the US-Europe partnership that underpinned global prosperity for decades. The US was Germany's top auto export market, supporting millions of jobs on both sides. Now, tariffs have replaced partnership with antagonism, eroding trust and making long-term investment impossible. The fallout extends beyond autos, threatening other industries and the foundation of transatlantic commerce. Defensive regional blocs are emerging, with Europe turning inward and seeking new partners in Asia. The build-where-you-sell model fragments the industry, raising costs and reducing efficiency. Instead of global specialization, companies are forced into costly duplication. The long-term cost, a poorer, less dynamic and less innovative global economy. As autumn 2025 arrives, the global auto industry faces a future defined by uncertainty and division. American consumers will pay more for fewer choices, while innovation and competition suffer. Iconic German models are gone, and American workers face job insecurity tied to unpredictable trade policy. The transition to electric vehicles is slowed, as tariffs and subsidies wall off the US from global innovation. The build-where-you-sell model will dominate, but at the cost of efficiency and investment. The historic trade axis between North America and Europe is fractured, replaced by regional economic fortresses. President Trump's tariff gamble is backfiring, hurting both domestic and foreign companies and punishing consumers. The crisis is a lesson in the dangers of disrupting global supply chains with blunt trade policy. The road ahead is uncertain, marked by higher costs, less prosperity, and a more divided world.